Welcome to the Futurati podcast. Any member of the Futurati is somebody who believes in the power of the future. We know there's a better world ahead, and we indeed have the power to make it so. In our podcast, we talk to the best minds in the world about the most urgent problems facing mankind today, and we hope you learn as much from them as we do. I'm Thomas Fry, a professional futurist and keynote speaker.
And I'm Trent Fowler, a machine learning engineer and author. Thank you for joining us.
Money has a long history, beginning with barter and leading all the way to your credit card. Kirk Hutchison founded Volt Protocol because he believes the next era of money is both deflationary and disintermediated. He studied history at UC San Diego and arrived at a libertarian bent after seeing the similarities between market processes and equilibria in nature. Inspired by the rich theoretical work on free money systems by economists such as George Selgin, Friedrich Hayek, and Milton Friedman, Kirk is working to put this theory into practice using smart contracts. If you enjoy this episode, please help us grow by subscribing to the podcast and sharing it with your friends. So hang on to your hats. We're going to talk about where the future of money really is with Kirk Hutchison. Thank you.
Kirk, thanks so much for coming on the show.
Thank you, Thomas and Trent, for having me. I'm really grateful to be here today.
Why don't you tell us a little bit about your background, your interests, and what brought you to working on the Volt protocol?
Well, I've always been a history buff. That's what I studied in undergrad down at UC San Diego. And I got into crypto originally through my interest in censorship resistance, more of the kind of cypherpunk side of things. I was looking at things like Urbit, for those who are familiar, and also things like mesh networks, cryptographically incentivized stuff like Helium or Althea. And that was what drew me in originally, sort of in terms of like as a user. I was experimenting with these things, and that's what got me interacting with Ethereum and smart contracts in the first place. And as I kind of got under the hood and started looking at how the smart contracts actually worked for things like Urbit's identity registry, it kind of dawned on me the actual potential there, and that was something I would like to work with. And that this was David for Bakeless put it really nicely, which is that Ethereum is a place where thinkers can start to tinker. And so you can think about applying some of these historical mathematical type of concepts in the real world and letting people use them more readily than in a traditional finance context. And so I thought I should get my hands on that. And I started learning how to code. And at the time I had been working as software freelancing kind of stuff. Along with history, I've always been into tech. I was in a robotics club in undergrad, and I got to work alongside programmers, mechanical engineers, that sort of thing. And I was doing just kind of web consulting sort of thing before I learned Solidity. Ultimately, I've come to the realization I'm not a great developer, but it was good to have those that foundation, that skill set that got me in. I did that for a little bit before realizing that I wanted to focus on the system design and the economics of it, and that's what led me to work towards Volt. And while on the can, Volt is a stable coin, what is the really core goal of it was the question of how you could build better governance mechanisms for allocating capital or governing the currency. When I was originally looking at these crypto systems, I looked at the lending markets that exist on chain today and thought, well, how could this possibly scale up to support 1,000 times as many assets, the kind of assets that exist in TradFi, without just being captured by committee rule, and still be a robustly decentralized or transparent market process, how these systems are controlled. And that was sort of the inspiration for me. And I've spent a lot of time looking at all the existing stuff and having fun being a user and dabbling in the projects that are out there. And also recently going a lot deeper into theory. As you mentioned, George Selgin is one of my very favorites, and also some older works, and just trying to learn as much as I can about the current state of the world economy and capital markets, and also the historical trends in order to figure out the best designs that we can.
So a lot of the newbies getting into the idea of smart contracts are still struggling with good ways that they can be used in the future. Can you give one or two examples that would just kind of light a light bulb in a beginner's head?
Absolutely. So, well, you'll have to make it a simple example. Maybe you can grant me a couple premises. One is that, let's say we start with two different assets. So if you're on Ethereum, you might have ETH as one asset, and then let's say that a separate asset is a stable coin, which is pegged to $1. We won't worry about where that stable coin came from for now, but you've got both of those. A smart, traditionally, if you wanted to exchange between any assets, right, like you want to buy or sell stocks, or you want to go buy a house, there's always going to be intermediaries. So there's going to be the stock exchange and probably multiple layers of intermediaries. There's the broker, then there's whoever is the banking relationships and counterparties that they have, and that's often not very transparent to the users, and it's layers of fees. With a smart contract, you could just make a module that says, okay, here are the rules for the marketplace, or how trades affect the price changes, and then anyone can go and swap between those two assets. And what's important about the smart contract is that everyone involved can see exactly what the rules are, and the challenge is expressing things very clearly and succinctly in the right rules in a program. And so we had these early versions of what we call an automated market maker, right? People are probably familiar with Uniswap,
yep.
Which lets you swap between many different assets. Mm-hmm. The first versions were a lot more limited as far as how many assets they could support, or the range of nuance in the prices. They weren't nearly as performant as the centralized alternatives, and people will tell you all these problems with them. But over time, it gets better and better. And also, as the underlying blockchain gets more scalable, and there's these things like rollups, you can do more and more impressive and sophisticated stuff with smart contracts. But you can also really, it can be a foot gun. There's a lot of ways you can go wrong and do dangerous things with immutable code or smart contracts too. So very much an early stage discipline. I often tell people that right now we're at the stage of when people were outside Caltech lighting off rockets in the gorge, and it's a far cry from when JPL is going to get established and there'll be actual industry-wide safety standards and other things. Like, it's still the Wild West, but I think there's a lot of, I've certainly seen tremendous progress all around in the last just year or two. And there's a lot of people with their nose to the grindstones innovating.
So you mentioned that one of the problems with TradFi is that there are all these layers of intermediaries standing between two parties wanting to transact, and that both incurs fees and also is a source of a lack of transparency in the ecosystem. So you don't really know what the rules are or how this transaction is being executed. And one of the advantages of a smart contract is anybody can go in and read the code and in theory anyway, know exactly how it executes, although reading code is its own problem. How that seems to me to be in tension with the need of the blockchain ecosystem to evolve user experiences and user interfaces around these products and services such that people don't have to go in and understand how it works. So how do you resolve those two things? I mean, ideally, in order for smart contracts to scale or any of this tech to really become socially meaningful, you wouldn't want people reading the smart contracts. You'd want them just using it and it works correctly, right? So how do you square those two things?
My answer to that is that this is where we need to delve into the nuance. And people often talk about cryptocurrencies as peer-to-peer. Mm-hmm. The question is, who is a peer? Not everyone is the same type of peer. Right. Not everyone is going to read smart contracts directly or even have their own crypto wallet and directly sign transactions. But the point is that because you can create structures that are disintermediated, that lets lots of new things emerge. And I don't think that there's going to be no intermediary at all, but it'll be a much more competitive free market. And who does the intermediaries? And it's more easy to create intermediaries. Or if you just, let's say the smart contracts are all out there. Well, if you just create a front end and market to people, you say, well, these are a set of safe smart contracts and we have our interface, and you know that everything in here has passed through our auditing and this is our financial services platform. Or it could even be, people often think more about the individual use cases than things like business to business use cases. But to me, even just the ability for any two businesses in the world to directly settle between each other using USDC instead of going through a banking intermediaries is a very powerful use case. And so it doesn't have to always be just person to person. It could still be cutting out the really big middleman and still having your little specialized local middleman. Cut out London and New York.
Could you briefly sketch why that's such a big deal? So I've read a lot about finance and monetary economics, as you have as well. So the idea of reducing friction in transactions makes sense to me. But I think that just your average listener who's not steeped in crypto all the time might not see why it's such a big deal for two businesses to be able to settle between each other in a stable coin as opposed to going through the banking system. Like, why is that such a big deal? Why does that open up frontiers of new possibilities?
Well, let me give an analogy that would make it very sensible from a consumer perspective. Let's talk about credit cards. When you go and swipe, I'm sure many people have seen things where there's a cash discount and they charge you less for cash than a credit card. And of course, that's because Visa charges a fee on the transaction. And some stores will, in that case, they're passing that fee on to you if you pay the credit card, right? And some stores will give you the option either way. And it's like depending on the country, could be a 1 or 2.5% even fee. It's not the same everywhere. And it changes sometimes, but it's a very large fee on every transaction that goes through that network. And then when you think about business stuff, there are similar things that exist for other types of transactions and transfers that everyone might not be as familiar with, right? When you talk about sending money between countries or across borders, there's the more different. Every type of company or middleman that it has to go through has to charge their take in order for them to exist. So if you think about like you're someone living in, country A and you want to send money to someone in country B, first you have to get your bank to send money to a bank in that country. But most likely if you have like a credit union or a small bank, they don't have a direct bilateral ability to relate to that bank. So it has to go through a money transfer network, which is established, whether it's ACH, whatever it is. Right. And all of those frictions, one, have some element of counterparty risk. There's a chance that things don't go where they're supposed to, or that, systems are, there's various degrees of safety or levels of wire fraud risk. But everyone is very aware of the risk and the hacks in crypto, but there's, wire fraud dwarfs that, right? The number of malicious transactions that are going through in these things based on people getting duped into sending things to the wrong place or access is getting exploited. And so all that complexity, it's just very hard for outside companies to break into it and to create like a rival network. And two, for people to really understand what's going on. And that's true with a lot of TradFi stuff. Like incumbent banks are very strong. It's hard to start a new bank. Visa is very entrenched. It's hard to start a new competing network. And so I think a lot of what crypto tries to do, and some of the secret sauce with the kind of incentives games that we play in crypto, is trying to break through that and get a new network effect established. Doesn't always go great, but the fact that the code is, if not immutable, at least the rules for its change can be observed. Right. So the terms and conditions under which can be changed, and not everyone can. But the hope is that as the industry matures, a growing body of concerned people can. And so we've seen bugs out in the wild in smart contracts for a long time before they were exploited and found. So that's a little bit scary. And so one thing we think about at Vault a lot is how the security need of the whole industry has to evolve and get a lot better. But as that happens in the community of like really literate security literate Solidity engineers grows, there'll be more and more possibility, and the contracts that are around for longer and longer can have exponentially more eyes on them. And ultimately you'll get these very, very secure kind of standard components that can be made very small tweaks to and composed to do new things. And that's sort of what I see it moving towards is, well-vetted and standard libraries and components being assembled into ways. And then it's a little bit easier for people to go through it and make sure it's secure because they already know, this and that are all fine. So we just need to check these little changes. A lot of things now are all different and ad hoc. So it's all these like completely different and very hard to understand code bases. And so you have to kind of spend a lot of time to be an expert in one of them, which is difficult for the engineers.
Yeah, a recent article I read, the title of it is that we need to burn all the boats. And the writer of it made the analogy of Cortez coming to the New World and waging war against the Aztecs. And one of his, the key tactic that he did is he burned his own boats so that they had no recourse. They couldn't go back. And so everybody was fully committed then, and they prevailed over a much larger army than them. So the thinking is that people that are working with Bitcoin or the Bitcoin maximalists actually need to live their life totally with Bitcoin. They need to pay all their bills through Bitcoin. They need to live their lives through Bitcoin. And my question to you is, first of all, is that even possible? I mean, do we have all enough tools to do that? And is it a reasonable thing to do at this point?
So I don't think it's very feasible for most people today, but I agree that it's desirable. From the perspective of a cryptocurrency advocate, I am, however, the difference between someone like me and a Bitcoin maxi is that I'm in favor of taking what incremental steps we can to get more people into a more self-custodial or decentralized thing. I don't think everything has to be only totally immutable and perfect, right? I'm not going to throw the baby out with the bathwater. To me, USDC is great, right? That's way better than just having, you're getting people on the chain, right?
Right.
Centralized exchanges are great. They're getting people to use crypto. It's a step in the right direction, even though they have problems. And therefore, I think that there are a lot of efforts to make it easier to use crypto in a given, it's very different in different jurisdictions, right? And the laws are always changing. People are, bonking around the ban hammer a little bit frivolously these days. So that's a risky business too. And I think that we'll blink and it'll be here, in a year or two. It'll be very easy to, in many, many jurisdictions, to have like a crypto smart wallet that you have a credit card attached to. I think we're very close to that. And I know that at Volt, we spend a lot of time thinking about how to minimize friction between people, putting their capital into Volt for their savings and being able to spend it in the real world. And we don't expect everyone to directly accept Volt, right? That means you have to get integrated with the existing payment rails first, and only later you need a lot of network effect to become a money, right? So like everyone in crypto likes to say, oh, it's money, Bitcoin's money, ETH is money, but it's a long shot from money, from people actually like saying, oh yeah, I'll take Bitcoin for my car instead of cash, right? Very rare, it would be more likely to say that you have a crypto credit card where you can spend your crypto and it's routed through a normal payment rail. So I think that is the first step, and having that kind of thing be ubiquitous where, save in crypto, spend in local fiat is the first step. And then once everyone and all your friends are doing that, you might as well just send crypto to crypto directly to each other, right? And that can kind of take off. I think that there is a path to that, but it's not a fast one. And I sort of have a gradualist mindset to real world penetration. It's not going to happen overnight, but slowly, then suddenly.
I suspect that's how all commodity money's developed. I mean, I'm sure there probably weren't gold maximalists in the first 100 years after people started circulating that as currency. I wouldn't imagine, right?
I've never heard anybody call themselves a gradualist, though.
An incrementalist, that's one I've heard. Well, the libertarians, they've got the incrementalists. I forget the other ones, the suddenists, whatever they are. But yeah, the people that advocate for repealing the law slowly and not,
The Big Bang approach,
burning it all down. That's fascinating. Are you following any of the projects like Coin Corner that are trying to build crypto payment systems that are entirely unreliant on the traditional financial rails? I was recently at a conference and Matt White was there, and he's one of the advocates at Coin Corner, and he gave me one of their Bolt cards and gave me some sats and said that nothing that just transpired in any way interfaces with the traditional financial system. It's all Lightning Network, it's all nodes, it's all on chain, and they're working on the Isle of Man right now, this tiny little island off the coast of Great Britain, to get as many merchants as they possibly can to accept Bitcoin, so it'll become like a Bitcoin island where you can use it freely as you would any other tender. So hopefully we'll get to see both things. Like we recently interviewed Patrick Friedman, right, who tries to go beyond the do we do it now or do it slowly kind of dichotomy, and instead just says let a 1,000 flowers bloom and we'll see what works. And if one of them works out really well, if there's a relatively stateless society or a minarchist society that functions correctly, that could just be franchised out in other ways. So maybe something like that will happen with crypto. I suspect that it maybe will be incremental and then very sudden, like gradually then suddenly, in the same way that Ernest Hemingway went broke. And these experiments, I think, are very encouraging for that reason.
Yeah, and like you said, there's a lot of jurisdictions out there. There's some countries that don't have their own currency and just use the US dollar. I wouldn't be shocked if in the next decade there's a country that fully accepts all these different stable coins and digitizes all of its payment rails through crypto. Something like Estonia, right? Who knows who that's going to be? But there's lots of jurisdictions. Hopefully there'll be more in the future, right? If we're aligned with Patrick Friedman. And I would like to see, more and more experiments, hopefully.
Hello, this is Trent Fowler, co-host of the Futurati podcast. One of the most common pieces of marketing advice I've come across is to know your audience and give them what they want. One difficulty in podcasting is that it's actually pretty hard to do this. None of the major platforms give us any way to reach out to you, our listeners, to find out what you enjoy about the Futurati podcast and what you'd like to see done differently. So we've decided to record this commercial and ask you directly to reach out to us. Head over to futuratipodcast.com, go to the contact page, and drop us a line. Tell us about your favorite and least favorite episodes, what you'd like to see us cover in the future, and anything else you want us to know. We produce this show for you, and we want your advice so we can make it even better. Thank you.
One thing that I have a lot of interest in is what the adoption of these crypto payment rails looks like in places that have a sort of like non-functioning state. And what I've heard is that, for example, on the ground in Lebanon, the primary type of like crypto payments adoption is USDT on Tron, simply because that was the first one that became widely available, and now it's integrated with the money changers, right? And like everyone knows it has a network effect there. And so I think that concentrated efforts in a certain jurisdiction to build up a network effect can be very fruitful. So it's something that we think about at Volt. It's hard to build up a network effect in the whole world all at once. But if a certain, like on the Isle of Man, right, getting all the shops to accept it, right, that's great. And so, a more local focus for bootstrapping a network effect. There's a reason that Facebook was started only for Harvard students, right? That was a smart call. You just focus very hard on getting this initial network effect, and then others are like, oh, I like that network. We should try that here too. So I'm a believer in that. I'm just not necessarily convinced that it will be a pure crypto rails that takes off. I think it's more likely to be like stable coinization in jurisdictions. Although, even though I'm certainly rooting for them, I think that's awesome. But that would be my guess.
Tell us a little bit about Volt and what you guys are trying to do.
So the main goal of Volt is to encode all of the things that make a bank in smart contracts, essentially. Volt is not a bank, but if you think about what a bank does, it accepts deposits from, savers and those who need to readily spend their money. So that's the two types of functions: is the convenience of an easier to spend form of money than the hard money, whether that was gold coins and you get dollars, or whether it's dollars is the hard money, then you get your digital dollars. You can spend it on your credit card, and then you can earn some yield on your savings. And then on the back end, they do loans and various other forms of yield generation with that capital. And, problems are that your funds in the bank can be arbitrarily seized. Everyone knows that both in legitimate and tyrannical regimes worldwide, there's been many problems with that, or like having the whole country's balances seized in the banks. It's very difficult to start new ones. They're only open during business hours, right? There's lots of problems with TradFi that smart contracts can help fix. And so what we're working towards is the idea of what I call a market governance system for deciding things like, well, let me back that up and give an example of the closest, like on-chain bank equivalent that's well established today that people will be familiar with, which is MakerDAO and the issuer of the DAI stablecoin. Mm-hmm. And so, DAI is the most well-established decentralized stablecoin. It's backed by a mixture of crypto collateral, over-collateralized loans, and also real-world assets and other stablecoins like USDC. And MakerDAO's token holders, the MKR token holders, vote on things like changing the parameters, like raising the interest rates on a certain type of loan, or what the debt ceiling is for a certain counterparty and things like that. And the issue is that vote-based systems really don't scale. The attention of all of the equity-like shareholders, the token holders of the Maker token, can't reasonably be, for one thing, paying attention to every single choice that's ever made within the system, and secondly, it means that the minority has very little say, right? It's very difficult to get a vote across and to get everyone's attention and everyone to go vote. And so if you're not a large stakeholder, you don't have an existing voice and reputation, makes it, there's various problems with this type of governance. And so what we would like is a system instead where one of the key concepts of a bank, and throughout history, not just under like a certain regulatory regime, is that the owners of the bank, the partners, put in some of their own capital, and they also take outside capital. And there's regulations requiring a certain ratio between those, where the bank has to have a certain amount of cushion on its books. And it is, both morally, good, you have to have your own skin in the game, or else it will promote toxic behavior, as we've seen with some of the recent problems in certain crypto projects too, which we could talk about. And so what we would like is that, if you think about a crypto system that has an on-chain reserves that are transparently viewable, and that the token holders could then direct the system's capital based on their pro rata share of the tokens, and their pro rata share of that reserves capital. And so the smart contracts are a framework for saying which types of yield venues or loans can be granted and are safe, and specifically allocating amongst them then can happen in a market process. So the goal this will be an iterative process, I'm sure, but the goal is to look at all these existing systems and say, okay, where are votes happening and how can we replace that with free market decision making, and allow that to have a scalable and open system, sort of the way that for Ethereum or Ethereum validators, the transactions that they accept are a free market decision based on a fair gas auction, right? People will try to say, I'll pay this much for a transaction or I'll pay that much, and that will decide how fast you get in the block, rather than like people voting, which slows down things. It creates room for arbitrary stuff. And so that's overall the Volt vision. And our main product is the Volt stablecoin, which initially was intended to be a CPI, inflation resistant stablecoin. And, it's a little bit of an embarrassment, but we've realized that a fixed rate target is a mistake because it forces the bank out further on the risk curve. And if you have a fixed rate, you'll always be, in certain market conditions, taking unacceptable risk that could lead to total loss. And what we want is never to have arbitrary, like magic numbers in the system, but rather feedback between the Volt holders and the governance token, which we call VCon, or the Volt controller, such that, for one thing, like a lot of stable coins are actually what I want to say here is that smart contracts allow us to do a lot more than people would think of within consumer finance, including giving rights to people everywhere in the capital stack. So we can do things like, imagine all the depositors in the bank could vote to fire someone from the board, just if you're holders of deposits, not shareholders. And so within Volt, we can do things like when the governance token holders want to add a new yield venue, some of the Volt holders could veto that, those types of ideas. And there's a lot of checks and balances that can be put in the system. And it's a hard problem to solve that is under active work, how the right feedback can be done from the savers and those who wish to allocate capital, such that the system is governed through the code and through the market feedback that occurs and the interest rates. There's none of the like central bank interest rate fixing. Interest rates are market based, and everything as much as possible can be handed off to an open process.
As I'm listening to you describe that, it still seems like you're talking a lot about voting mechanisms, though. So is it really that voting's the problem, or that you've got some way of distributing that power more broadly throughout the system? Because you said we want to replace it with market mechanisms and feedback, but most of the examples you had is like, well, they can veto a new yield channel, or they can vote to eject a member of the board. So it still sounds like you're talking a lot about voting and that kind of governance. So what am I missing there?
You're right. I was diving into what were the sort of unanswered questions in Frontier for me and getting a little ahead of myself. So let me give the market governance
take us
from
there.
square
Take
one,
us
which
there,
is
one step at a time.
So I'm someone who comes and mints Volt, right? I'm going to bring another stable coin. Let's say it's USDC or DAI, and I deposit it into the Volt smart contracts and get Volt out. Volt does not have a fixed peg to the dollar. It is dollar denominated, and it accrues the yield into the price. So, you could get a certain price today and the price would increase based on the yield that's accrued in the system. So you've got your Volt token. Later, when you want to withdraw, you can redeem it and get stable coins out. Once those stable coins are in the Volt system, the way that market governance will work, and this is not live on chain yet, is that an individual holder of the governance token could borrow some of this system capital and go deploy it into one of the whitelisted yield venues that's been approved. So let's say that that's a lending market like Ava, an existing crypto lending market. Mm-hmm. You as the governance token holder, let's say that there's a total of $10 million in the Volt system and you hold 10% of the governance token supply. You could then go and direct $1 million of capital into the Ava lending market. And you will be earning a portion of the yield that's generated in that market, and a portion of it will be passed back into the Volt system. That which is going to the system surplus and the Volt holders. And in turn, you'll be exposed directly to the risk in that venue that you chose. And the other holders of the governance token will be exposed to the risk in the venues that they've chosen. So in a situation where the Ava lending market took a loss and you were unable to withdraw and repay that capital, you'd be liquidated. So that VCon tokens would be seized, and any remaining collateral would be withdrawn into the system, and the surplus buffer would absorb that loss. Where and this is trying to address some of the tragedy of the commons problems that happen in governance today, and also making it so that there is a direct utility of the token. It's not an episodic vote, but this allocation can happen in real time. So anytime an individual holder could decide that there's a better rate somewhere else and go deploy their portion of the capital there. So it's a framework in which, instead of centralized, episodic votes being needed to make any change to the system, the holders of the governance token are incentivized to make real-time allocation decisions among the yield venues. And then the various checks and balances and the voting stuff I was talking about before relates to the bounds and limits that need to be put on this process. And that's, the thing that needs to be thought through very carefully, and what the devil is certainly in the details with smart contracts. But what's different about this is that you can envision there being hundreds of individual decision makers who do not need to coordinate with each other in order to make allocation decisions within the system. So it's a lot more scalable and decentralized than a vote-based, episodic vote-based model.
So if they just hold a certain fraction of all the volt in existence, then they can make certain decisions which will impact the ecosystem more generally, but they're still on the hook for it, right? So you're trying to ameliorate the problem of moral hazard by not,
that's right,
presumably letting them get too leveraged or what have you.
That's right. And to clarify, these are the holders of the governance token, which we would call VCon. And the Vault Controller, which is my cheesy little name for it. Who knows? I might have to rebrand this thing at one point. But I was all by myself when I picked the name. So
VCon kind of sounds like a meetup for incels. So like you might.
Yeah. We might change it to MGov for the market governance token. We'll see. Got to think about it a bit more. But that's what's the key. And when I say all this stuff, I'm now speaking sort of like to the existing crypto landscape of what differentiates Vault from these other stablecoin protocols. What makes a stablecoin good in itself, it's sort of a separate question, but I believe that this market governance process will ultimately make something that's a lot more fair and open. Like today, if you want to get a loan from MakerDAO, it's like, well, good luck. You've got to make a proposal and you've got to go through the committees and then a vote's got to happen. It's difficult to even know what you have to do or how long it will take, what the expense would be. Whereas with Vault, we want there to be transparent processes by which, new venues can be evaluated and deployed, and which capital can be deployed into those venues, and also by which system participants can object or prevent these changes. So, there's a lot of moving parts in a decentralized smart contract bank, but that's the goal. And then eventually it could replicate a wide variety of the functions of a bank, including originating different types of loans. That's a little bit more complicated than. In the initial version, we're focused on allocating among existing, markets that are in cryptocurrency, these lending markets that are on chain, and letting the market governance participants choose how much of the system funds are deployed between those. But eventually we might look to developing our own tooling to allow even more expressiveness of deploying that capital in the real world as well.
This may be the sort of question that's almost impossible to answer without getting way into the weeds, but I've been following some of the drama with 3AC and Celsius and Luna Terra, and it's not to say that it sounds like you're doing the same thing. It doesn't. But when you get into these questions about people owning fractions of all the capital, and that means they can do these things and it can redound throughout the system in various ways. And it's like there's these complex feedback mechanisms and a governance layer that functions on smart contracts. It just starts to sound like eventually somebody's going to figure out a way to drain the liquidity pools like they did with Luna and then short Bitcoin to the tune of $800 million and crash an entire part of the crypto ecosystem. Like, is there a succinct way for you to describe why this system is not vulnerable to those same sorts of shocks?
Well, I think first, the people should be very wary of smart contract risks and overcomplicated systems. So by no means do I want to minimize that. And we can talk a little bit about what our stance is on security and how we think about what it looks like to actually build one of these systems. But what I will note is that the truth is that there's nothing fancy or complicated about what went wrong with those systems. And that, Luna was a fundamentally broken and bad model, and anyone who is not self-motivated to convince themselves of otherwise and has a decent understanding of economics could see that. And on the other hand, there's smart contract risks where you have a hack or an exploit where it's just a very small nuance in the code where only a small number of experts in the world would be able to prevent it. And then you have things like some of the most infamous hacks are really the simplest and the dumbest, like the Axie Infinity Ronin bridge hack was just, it's only a few people who have the keys that control the bridge, and it was compromised. nothing as fancy as like, oh, there was a deep flaw in a mechanism. It was just some guy had the key to the safe and he walked up to it and he took what was inside. And so
right.
and so there's both. I think that this last year or two, there was so much money flowing around in crypto and so much hype. It's naturally easy for people to get greedy and for voices to dominate the discussion. If there's so much noise, it's very difficult for people to filter through to the signal and find the things that really are or aren't good. So that's one issue. And I think that just as the industry matures, they will be more recognized like leadership figures and common groups. Like, there's already been talk, between some of the stablecoin developers I know about things like common and jointly agreed risk frameworks where they'll do mutual ratings. And I think that these types of things will be helpful, but also the field of smart contract engineering should be viewed like aerospace engineering, right? Like, there is no room for error. There's no room for rush. Everything has to be triple checked. Everything has to be done according to spec. You need separate security and build teams. And you need it's not enough to just do an audit where some opaque firm gives you a check mark, right? You need to have a team where you sit down and, go over it again and again. Any integrated code, any venue you deposit into, you have to treat as your own code because any governance change in that system could lead to an exploit. And so we at Volt have been working a lot on building up our own infrastructure of security auditors where we can, instead of being dependent on a audit firm where, it's something that everyone who works in crypto knows for the past year is the common complaint of any project dev is you can't get good audit time. There's only a few very well-regarded top-notch audit firms in the ecosystem. A lot of others are just rubber stamps. It's very expensive and it takes a long time to get time with them. So working on more peer review of smart contracts and also having networks of independent auditors. I just think that, a cryptocurrency project is not like a software startup. It's like an aerospace startup. It has to be done very, very carefully. And you have to be very cognizant of the risks, and a strong engineering and security culture is essential. And I hope that over the next few years, that will become just more the norm in the industry. There's a lot of projects that I regard very well that have very great security practices. There's a lot of others that have terrible security practices. And as these exploits occur and industry leaders become well aware of who is doing a good job and who's not, my hope is that there'll be more watchdogs and clearer transparency. There already are quite a few public watchdogs, people who are on Twitter or other places who will be calling out those who are doing bad practices and warning about it. So giving those people more of a voice also helps.
When you say projects, do you mean smart contract projects, stable coins? What do you have in mind?
Yeah, any smart contract crypto protocol. You can call them projects. A lot, because some of them are, so-called DAOs. Others are companies. Some blend of the two. But anything that is building smart contract systems, because there's no take back fees when you have code that handles a bunch of people's money.
Right.
Yeah.
The site can't go down and go back up an hour later and it's fine, right? It's no, if there's a problem, it's all over.
What was it, Cardano, that froze the blockchain for a little bit and then turned it back on later? You can't turn the blockchain off.
The Solana.
Yeah. Was it Solana?
Yeah. There's more than one, but okay. Solana was infamous for that problem this year.
Okay. I don't want to impugn anybody if it was Solana. I didn't mean to say Cardano.
Yeah, this is such a Wild West environment that we're in right now, and lots of experimentation going on. Lots of testing out of new technology. If you could roll the clock forward 10 years, what's your best guess as to how many survivors are still out there, and then what are they doing different than the others that give them the longevity, that give them the ability to last longer than the other alternatives?
Well, I think that zombies will surprise us with how long they can last. That would be one prediction I would make.
All right.
I think that in 10 years, there'll be a lot of things where I'm still shaking my head. I'm like, why is this still here? But eventually, right, that is separate from the question of the winners distinguishing themselves, right? There's a lot of things now when I look at it, I'm like, this is crazy that it's taken things like, Ripple or Cardano. There's many projects where I think that it's just an overt, it's a borderline scam, and it's very strange that it's still very, mainstream and popular and even listed on exchanges for retail, like in the United States. Or you'll see the kind of things that the Coinbase exchange lists sometimes, and I'm just like, oh my goodness, that's. But at the same time, there are real businesses, and business not in the case of in the sense of a corporation, but in the sense of a valuable service or product that is sustainable in people's lives that are being built. I think stable coins, I'm biased, are a key use case there. I think decentralized exchange is another, although it won't look exactly like necessarily like a pure smart contract decentralized exchange. I think that things that are like intelligent hybrids of smart contracts and off-chain stuff will have a lot of value, because just like how everyone uses a trading app and doesn't place orders directly on the New York Stock Exchange, not everyone's going to place orders directly on Uniswap, but they'll use things that save them cost or bundle orders. There's lots of things that can make things easier on retail or smaller users. And then at the same time, there's this building legitimacy for institutions. So I'd keep an eye out at where like actually serious institutional partnerships are being done. So for me, I look at like MakerDAO, who's giving $100 million credit line to a U.S. Bank. I'm forgetting the name of the bank now. I think it might have been the Huntington Valley Bank, HVB, but maybe don't quote me on that. And has done a big bond deal with the largest bank in France. Like, that genie's not going back in the bottle. BlackRock investing in Circle, that genie's not going back in the bottle either. These crypto payment rails are going to get a lot bigger. At the same time, I never advise anyone to buy governance tokens. Like a lot of, it's the Wild West. Most people should not have been buying stocks in the .com bubble, right? It's not something you should mess with. But if you're someone who's interested in the future technology, you should certainly pay attention to the .com bubble if you're living in that time and go look at what's being built. And often there's things that are just ahead of their time. Like we see that many cases of that now, when we can look back at .com bubble companies and be like, oh, isn't this just like this? I'm blanking on examples, but there's definitely .com examples of things similar to Netflix or Uber, and just various things that were constrained by a lack of bandwidth or a lack of adoption of the internet at the wrong time. And so as these crypto rails become just more generally adopted and the whole basic premise of it becomes more common, new things will become possible that weren't before, even if they may have been tried.
Do you need a dynamic and knowledgeable speaker for an event? Thomas Fry and me, Trent Fowler, are both seasoned keynote speakers, able to converse on a wide array of topics to audiences of all sizes and skill levels. Go to the contact page at futuraudiopodcast.com to book Thomas or myself today, and let us apply our years of experience in public speaking to make your event a smashing success.
Yeah, what's that example you're always using, Thomas? The pre-Amazon, the Amazon from like 1992 that went bust, and then almost the exact same thing worked when Jeff Bezos tried it like a decade later. They were delivering groceries or something. It was a whole warehouse.
Oh, yeah.
What was that called?
Yeah, they spent
$1 billion
literally billions on this the grocery startup.
And it got really
that one will be in the show notes, I guess.
Yeah. Boy, there's a lot of hype around that one.
They just couldn't quite do it, but then later on, Amazon's doing almost the exact same thing. It had to be proved out first, and the infrastructure had to be there, and people had to be more comfortable with putting their credit card online and making payments on the internet and banking online and all of those things. And they just weren't there yet. So they were visionary, and they paid for it. You want to be like optimally visionary. You don't want to be too visionary, because then you're just a crank yelling at the clouds and going broke. But if you're visionary enough, then you can make billions of dollars. Earlier, way back in the beginning of the conversation, you said that you were interested in things like system design, and you specifically mentioned Urbit. Incidentally, I think episode 9 we did with Tlon's CEO, Galen Wolfpolly. So you want to check that out if you're interested in that. But I just wanted to give you some space to riff on systems design and governance and economics and game theory and whatever else. So what's on your mind as far as those things are concerned, and how does that interact with crypto? Maybe tie it back with crypto somehow.
I'll give some context. Is that my first system design that I was really into was like gardening and nature systems and permaculture design. And that evolved into looking at economics. And it's really the same type of thing, is that everything is like natural selection and push and pull. So looking at where the kind of like feedbacks and competitive pressures are in these systems is, just a lot of fun for me. And of course, getting to poke and prod at them. And so Urbit, right, is an attempt at kind of rebuilding the computing stack from square one, at making a more decentralized platform for people to use, and a basis for a different type of software. That's kind of a bold and radical experiment. What interests me, though, is how they, when I first saw Urbit, I thought it was very interesting how they encoded like the networking hierarchy between the, it's sort of like the DNS routing infrastructure, but tokenized and in these smart contracts. So you can own the right to be a certain node in the network. So I thought that was interesting. Just because you have tokens doesn't mean you have adoption, right? And there's a lot of crypto projects that, have very fancy, intricate tokenomic schemes. But at the end of the day, right, like there's no such thing as a perpetual motion machine. Someone has to have a reason to use it. Mm-hmm. And with Urbit, actually, there is a steady uptick in use, and real growth and real adoption always takes time. In order to be, there's the old adage of like, secret to overnight success is first work 20 years in silence, and then, and so one of the things that's been on my mind a lot recently is just a few things, looking at historical currency transitions, transitions between currency systems and using that to inform how we might expect these crypto rails to go. Because I don't have any clear answer to the question of how could a successor to the US dollar be globally established? What would that actually look like? I have some ideas about how it might start, or what might be our next step from here. I think that more decentralized and permissionless rails that wrap dollars is a nice step. It's like the super euro dollar is stable coins. And I think that there'll be a lot more direct bilateral relationships between companies and financial entities in the world over the next decade than there are now, thanks to crypto rails. So we'll see more of, decentralized exchanges or clearing houses. I think it'll be big in things like foreign exchange and international like bond markets type of stuff. But it will also take a long time for everyone to get used to using these systems. And when we look at transitions like how everyone actually started using, bank cards or these type of systems, they are usually pushed by some kind of powerful entity. The U.S. government played a major role in the establishment of, banking cards and the these electronic and ACH systems. I might be scrambling which project was which, but they, tied in Social Security, like signing up for a certain Social Security payment to using one of these electronic systems that greatly benefited adoption. I think that was the SWIFT network. But I'm going to have to check myself on that too. As you might know, I have observed, I'm not very good with numbers and names, although I'm decent with concepts. So I often find myself having to check my notes for like, what was that from again? But that general premise that just because there is maybe a better equilibrium doesn't mean that there's a smooth way to get there, and you might need a push to get you going, just like the spark to start the fire. And so that's something that I've observed. And so lately when I first started on the Vault journey, I had a very global focus, like, oh, this is just for everyone. I don't need to even think about who the specific user is. And now I think more like we need to focus on getting Vault adoption in a very specific country or region. And just like, we have El Salvador trying to force Bitcoin adoption on people. I don't agree with their methods. But if you can find a place where the, municipal or state authorities are open to experimentation, open to change, and then you can run incentives with businesses. And, I think that a lot of the camp that I'm in within crypto has always been the very much on-chain decentralized camp. But a lot of people there are purists and don't like to go the last mile into the real world. But to me, that's sort of one of the heart of the problems. And so when I think about like my competition and who I'm trying to outfox, it's people like one, USDC and Circle, these big centralized stablecoins, and two, possible central bank digital currencies, which, if you'll pardon me for waxing ideological for a little bit, I think are very dangerous. And that, like, subjecting money to political control is not good, because any process, and this is again why I'm against, it's either national or corporate political control, right? Either way is bad. A money system should be based on neutral rules that are outside of human control, ideally, right? That's what was good about the gold standard, and why some people wish to return to it. But once again, once the cup's broken, you can't put it back together. It would take a coordination that doesn't exist to move everyone back. There's no natural incentive process that would cause everyone to coordinate back to a gold standard. And so, whereas the U.S. sort of like actively caused everyone to coordinate to the dollar standard that we're under now. So I suspect that these kind of competitive private monies will actively make efforts to spearhead their adoption. And those inevitably, and this is where we'll bring in George Selgin, is that I think that ultimately where we're headed to is a more competitive global financial ecosystem, which is good. And that networks and interlinks will be made so that it's relatively seamless, but for a lot of users. but this competition will lead overall to more value being passed on to users and less, less fees, less exploitation, and just the general idea of that in a society with a growing economy, there's no reason that your savings shouldn't increase in value and that you shouldn't gain more purchasing power over time. We have advancing technology. We have more and more and better stuff over time. There's plenty of room on the earth. There's no reason that if you have your savings in currency, you should suffer the effects of deflation or have to pay high fees just to access or spend your money at a store, right? The idea that there's a 1% fee when I go to spend at the grocery store is kind of outrageous, right? Like, it's a simple process that happens all the time, countless times over the country. And if there's ways to cut out those middlemen and return 50 cents or 75 cents out of every dollar, 5 cents or, 25 cents out of every dollar spent to, I'm really going to 5 or 2.5 cents of every dollar spent to the consumers and the workers. I think that's really a noble goal. And so that's part of what, a lot of crypto people say disintermediation is one of the primary values, censorship resistance, disintermediation. And I really believe that too.
Yeah. So we've actually had quite a few discussions about the economy on the Starship Enterprise. And
As one does.
Yeah. As you think about, Elon Musk is planning on shooting a spaceship to Mars with people on it. And to think about, okay, how does the economy work on this spaceship going to Mars? And if we actually send like 1,000 people on a spaceship, like some flying ark going to another planet, how would the economy work there? And are those people subject to the laws of Earth when that really makes no sense whatsoever, because they're not attached to anything on Earth? It occurs to me that somehow this abstract thinking about the economy and foreign bodies ties in with what a new global economy would look like, and setting ourselves up for that might be what the actual next currency is that takes over and dominates instead of the U.S. dollar. I don't know. Do you have any? This is a really crazy ass question to ask you, but does this tie into any of your thinking at all?
Oh, it absolutely does. And on the more nerdy joke side, but my wife and I were batting around the idea of an article called Interplanetary Nakamoto Consensus, meaning basically that you have to think about things like the light speed lag when you're talking about currency systems doing settlements interplanetary, because it takes a few minutes. So you can't do instant transactions, right? But that's more of a joke. But the real world analogy we can bring in is that for any colony like that, and for any like small or startup society, the key question is its import-export balance, right? How that society thinks about money is to think about what does it need to import and what is it going to pay those people with. And so this is I've been doing a lot of research lately thinking about, which jurisdictions can we focus on for initial Volt adoption. And part of that is looking at how countries control capital inflows and how trade balances work, because those motives are very tied up. So you'll have, for example, in Argentina today, if you're an exporter and you sell goods overseas and you receive foreign currency, you are required to convert that foreign currency within a certain amount of time to the domestic currency at the official exchange rate. And because, they have certain obligations that they must meet in foreign currency. And so they do, by hook or by crook, they've got to get it. And so I think that a similar situation would prevail in this Martian colony, and that, the Martian colony has a limited supply of hard money that it needs to use for trade internationally. Secondly, from that, it has an internal economy that circulates purely within, which is a little bit separate. And a lot of governments and nations will try to manipulate that separation, either to their benefit or the benefit of their citizens. Not for me to say, but one of the goal of crypto systems is to sort of remove that, right? To make everything on one global financial substrate, so there is no separation between national currency systems. So that's the status quo today. And so you can imagine the difference between like a Martian colony that uses physical currency on the Martian colony and then deals with digital dollars on Earth, and one that just uses digital dollars and they all have the same, can an individual Martian citizen directly make transactions with an Earth citizen? And if you can, That's a much better system than, you have to go through one, Martian bank. So you can buy and sell things on Mars, but you got to rely on an importer. It's difficult to get that Earth currency to deal with. And so that's a problem that's why everyone wants the most usable currencies for international settlement, which is dollars and, maybe to a lesser extent, renminbi, depending. And that's the key competitive dynamic in global currencies to me today is, countries have import-export balances, and they need to make sure that they don't mess up with this separation between their own currency and the currency of international commerce. So they get into trouble when there's mismatches between, let's say, their debts and their assets. So we have problems, certain countries struggling with that today, where they were holding a bunch of U.S. bonds, and then the U.S. raises rates, and so the value of their bonds goes down, and then they have debts in their own currency, and we'll end up like Japan between a rock and a hard place of allowing inflation or having a bunch of companies unable to service their debts and go bankrupt. And so that is a driving force, I think, for dollarization, and I think hopefully crypto dollarization.
Are you enjoying this episode of the Futurati podcast? If so, please like it, give the show a 5-star rating on Apple Podcast, Spotify, or wherever you get your podcasts, and share it with your friends. By far, the best way to help us grow is to spread the word on social media, which will expose our content to more people and help us continue to bring you interviews with world-leading experts in AI, quantum computing, cryptocurrencies, and so much more. Thank you in advance. You've said that you're interested in a post-scarcity society. Can you talk a little bit about what that would be like?
So I think that, we shouldn't speak in absolutes. So post-scarcity doesn't mean there's absolutely no scarcity, but it means that the amount of the share of all human resources needed to sustain the basic necessities of human life is going to a vanishingly small percent. Just like how the portion of people who work as farmers has gone from almost everyone to less than 1%, in industrialized countries. And as we get more and better technology, you eventually reach a point where it should just be, imagine a world in which there is ubiquitous nuclear power, such that electricity has a 99% reduction in cost from today. Everyone in the world is connected to the internet. All these financial systems are disintermediated. Automation has progressed by leaps and bounds such that the amount of workers in average factory is down by 90% for the same output. These are all readily enough things to see happening in the next few decades. Each one might have its own timeline, but there's a lot of things coming together such that, except for artificial scarcity, like we see in things like housing and healthcare, things will tend to get cheaper and cheaper until a certain point where hopefully we should just be able to automate basic well-being at the social level. So that's why I am a pro-UBI individual, although not necessarily like pro it should be implemented immediately, but that it is a natural direction, and that, work has become more and more knowledge heavy over time. And so just like with these smart contract things, like building a complicated math system really, really well could allow you to cut out tens of thousands of banking jobs and save bank depositors quite a bit of money. And like with all technology, the goal is not that those people are out of work, but that they can do other better things. And that's what tends to happen with markets. But it's, my belief, and I think a lot of others, that we're starting to reach the point where, a large number of humans, their direct physical work will not be worth a very large amount to other humans. Because the things that they can produce with that work are cheap and readily available, whereas the things that they really want are more expensive. And so being able to make sure that everyone has those basics and then work and compete freely to get better, I think is a good direction to go, rather than like heterogeneous benefits regimes or trying to directly modify the cost of certain things in society.
That's fascinating. Do you have any other thoughts you want to leave us with as we're wrapping up here?
Well, just that, I think that to anyone who's listening from outside of crypto, know that crypto is not as weird and strange as you think. It's a lot like regular finance and regular history, and that once you peel back the jargon, just accept the jargon, hear it. It's a little bit, it can be inaccessible. Once you get through it, you'll see that the 1 + 1 still equals 2 things still add up. And for people who are inside of crypto, read a few more history books, read George Selgin if you're working on a stable coin. And just thank you so much for having me. And I'm always happy for anyone who wants to talk shop to get in touch. I'm OneTrueKirk on Twitter.
Fantastic. Thanks so much, Kirk.
Yeah, this is great. Thanks for handling all the weird questions.
No, I had a great time. Thank you two so much for having me.
All right. All right. Thanks.
Have a great rest of your day.